Good evening. Good evening, folks. Happy Tuesday.
Happy Tuesday.
How you doing?
I'm doing good. How are you?
I'm great. I'm great. Can you hear me okay? I have my air conditioner on.
Yeah, you're fine. I can't hear it coming through.
Great. If I turn it off, it might start melting. So
yeah, no, I'm with you.
Awesome.
For some reason, my office is like the hottest room in my house, so I'm always like running a box fan.
Yeah, it's like my office is like a refrigerator, and then the rest of the apartment is like a sauna.
Gotcha.
Welcome, folks. Thank you so much for stopping by. We'll wait like one more minute, and then we'll just go ahead and get started. I see some familiar faces in the audience. Hello, hello. Special shout out to Hannah, who's our investment operations associate. She's going to learn a lot in this webinar, I bet.
Hey, Hannah.
Alrighty, I'm just going to go ahead and get started. So I am going to share my screen. We are recording. Yeah, here we go. Y'all can see that? Great. Okay. Welcome to negotiating your equity compensation in today's markets. I'm Allie Jane, aka AJ Ayers. I've got some designations, and I'm one of the co-founders here. And
I am Caitlin Murray, but I go by Kate here at Brooklynify. I too have some designations, and I am a senior financial planner here with the planning team.
Awesome. And Kate, what's unique about you is that you don't just have designations about taxes and equity compensation. I've got those. We're both CFPs, but you have some other letters here. What do those mean?
I do. So I have my financial behavior specialist certification, as well as a certified financial therapist designation. And those are just, different designations that allow me to work with clients differently, relate to clients differently. So in addition to having the CFP kind of tool set, I also have a lot of really cool tools for working with clients on how to implement the financial plan. A lot of times we do a lot of really good planning and really great technical planning, and then we fail at implementation, which of course is the most important part. So my background is in financial psychology and behavioral finance, and helping people actually live the fabulous plans that we create.
Awesome. Yeah, we're going to talk a lot about that today because equity compensation, as you and I both know, and any of our clients know who have been in meetings with us, it's not just about the numbers. It's not just about the tax. It's about how you react to it. And so much of equity compensation is about emotion. I would say a higher percentage than people are willing to admit. So we'll talk about that. Before we get started, drop your questions into the chat box. We will try to answer them live. We've also got some questions that folks submitted ahead of time. And we are recording, so we will post this to our website, brooklynfi.com/events in a few days. So today's agenda, we've got the ABCs of equity. Oops, forgot a word there. I'm gonna whiz through that part. We've covered that pretty extensively. This is not to teach you about the different types of equity. This is to talk about how we handle it in this bear market, which Kate is gonna walk us through. I'm going to talk a little bit about benefits and how to evaluate compensation, because equity is one part of that. Your salary is also one part of that. Those are the benefits we talk about a lot, but there's also a ton of other benefits that companies offer that we'll go through and try to assign a value to those. And then I'll talk about negotiating for more in an existing role that you already have. And then Kate will take us home with negotiating for a new role when you have a job offer. So let's get to it. Typically, we talk for between 30 and 40 minutes. We might start rushing through at the end, and then we'll leave some time for questions from the audience. So looks like some more folks joining. So yeah, welcome new folks. Let's jump right into it. Yeah, love a meme break here. Love a bear market meme. Thank you. All right. The ABCs of ISOs, NQOs, and RSUs. What are these things? Like I said, I'm going to kind of blast through this a little bit. I'd love to sit here and talk to you all night about ISOs, RSUs, and non-quals. That's what I do all day. So I'm going to go a little bit fast, but this is one of my favorite visuals on the internet. It's from, I think it's a Wiki Commons graph that we stole and had our designer redo in Brooklyn FI colors. So this is the startup financing cycle, and this really helps us understand, depending on the type of equity, we can basically kind of guess where the company is in the stage of their growth as a company. So in the beginning, we have founder stock. You're the founder. Maybe you're getting some of the original issued stock. Your co-founders are too. Maybe you bring in some early angel investors, some seed money. Those are people getting in really early. Does anyone know what FFF stands for when we're talking about an angel round of funding or a seed round of funding? Does anyone want to drop that into the chat? FFF. It stands for families, friends, and fools. So these are the people who are willing to give you money early in your company's journey. Anyway, so in the early stage, so once we're kind of past that valley of death of getting the company off the ground, hiring some employees, typically early on, we're going to get offered ISOs or incentive stock options. And the big secret, the big reason why companies offer ISOs early on, yes, they're great for employees in terms of taxation, but they're also really great for the company in terms of taxation, because there's a lot less accounting required for ISOs because there's no taxation that has to happen if anyone decides to do anything with those ISOs. So I always like to point that out. That's why ISOs are typically granted early on. As the company matures, typically we start to see companies move away from ISOs because they're very valuable to the employees. But really, it's once we start to head towards IPO, we're in series D, E, or F. Typically, we start to see options shift away from ISOs, incentive stock options, to NSOs or non-qualified stock options. We use NSO and NQO pretty interchangeably at Brooklyn FI. Same thing, NQO equals NSO. So once we get to that point, we're still raising money, and then typically once we get to IPO, whether we're going public via an IPO or there's a different kind of liquidity event, there could be an acquisition, there could be a SPAC, there could be a direct listing, but essentially when shares are available to be traded on the public market, that's typically when we see the click over from stock options to actually stock units, which are typically granted as restricted stock units or RSUs. So those are our ABCs. I think this graph is helpful to show the trajectory of those. So briefly, RSUs, those are our restricted stock units. Those are shares of the company stock awarded in exchange for service. We're here to talk about equity compensation. RSUs are the purest form of equity compensation. Literally, instead of cash in your paycheck, you're getting shares. It is kind of confusing because the cash shows up in your paycheck, but instead of the money going into your bank account, the money lands in the form of shares into your investment account. So typically we see this at public companies. Occasionally we do see RSUs at private companies. We've got a bunch of other webinars about that. So check out brooklynfi.com/blog and just search for RSUs, ton of great content there. So yeah, these are often awarded after the IPO, and there's no control over the price and timing because RSUs are typically, or all of our equity compensation is going to be snapped to a vesting schedule. So I'm sure if you're on this call or you're watching this webinar, it's probably because you're not really thrilled with the timing of the vesting of your RSUs because you don't have any control over it. So market's experiencing a bit of bumps these days. So last year, maybe your RSUs were vesting, you were getting $100 over here, $80 over there. Now the stock price is not what you were anchored to. It's not at $100 anymore. Maybe it's at $50. Maybe it's at 40. I'm smiling to talk about this difficult thing. That's like a tick that I have. I'm not excited that your stock price has tanked. I'm just letting you know that things change. We don't have control over it. They're vesting. The train's already left the station. So let's move on to non-quals, our non-qualified options, aka our NQSOs or NSOs. Lots of different names for this thing. So as opposed to our stock units, which are actually granted as shares. NQOs are in our stock options. It's the option to purchase a share of stock at a certain price. And NQOs are very interesting right now in this bear market because we are seeing a lot of companies issuing stock options, public companies issuing stock options in the form of non-qualified options. But the price is so volatile that a stock option that was granted 6 months ago or even 3 months ago is already worthless. And Kate's going to talk to us a little bit about why shares might be worthless. So RSUs, they're vesting at whatever price. We get the shares, we are able to sell them for cash. Non-qualified options, again, it's an option, and there's a price that you're anchored to when you originally get the grant. So NQOs, I would say, in my opinion, are probably the most dangerous type of equity right now in this bear market. Our clients are forced to make difficult decisions with recently granted non-qualified options. So I'm kind of afraid of these right now. And when we're going to talk a little bit about negotiating, if you have a choice at the moment, and you got to understand your own risk profile, you got to know what your own financial plan is, but kind of speaking in a vacuum, RSUs are going to be the least bumpy. They're going to kind of be like your safe bet in this environment. Obviously, markets are cyclical, so that advice changes with our clients as the markets move. So yeah, like RSUs, just want to point this distinction out. They are taxed when you decide to exercise. So RSUs, trains left the station, we have no control over them. Non-qualified options, they're options, we have to take an action to actually own the shares. And then ISOs, similar to non-quals, they're also options, but there's no tax consequence when you actually decide to exercise. The biggest thing with ISOs is this scary alternative minimum tax, or this AMT. I see a lot of clients on here who I've spoken to for hours and hours and hours about AMT, lots of other stuff about that. But essentially, I think in this market, when we may have a lower price than we're used to, there potentially are opportunities to exercise these ISOs and not sell them right away and to hold them for the future if that's part of our financial plan, if we have some excess cash around to do that. So that's our ABCs, that's kind of our entry. So I am going to hand it over to Miss Kate Murray. I will click for you, so just let me know when you want me to move on.
Awesome. Thank you so much. And thank you for that overview of equity comp. Great. So AJ kind of went over how different forms of equity compensation work, right? The ABCs of equity comp, of all these different letters that we stick together. I'm kind of going to address more what our perspective on equity compensation should be during a bear market. So a bear market is defined, if you don't know, as a stock market decline of 20% or more. So we are solidly in bear market territory actually right now. And as we all know, because I think a lot of the clients who have joined us today are tech-based clients, people who are working in the technology fields, have felt that market correction perhaps a little more strongly than others. I've got a graph here of the Renaissance IPO ETF, and this is an exchange traded fund that tracks IPOs and companies that kind of follow that pattern. And you can see that has contracted by about 30%. So not necessarily a great time. If you listen to the liquidity event podcast, that we've been going through a dry spell with our IPOs. But as AJ mentioned, markets are cyclical. And I think that's the number one thing to keep in mind, right? We have been long overdue for market correction. We've had 10 years of very strong returns with very little upset. And so I think the biggest thing to keep in mind is that markets are cyclical, and also that your planning team at Brooklyn FI has planned for this, right? We knew this was coming. We couldn't tell you when. We couldn't predict the future, but we did plan for exactly this because this is what we know about markets. So with that in mind, some key points to keep in mind when we're thinking about equity compensation at times like this. Number one is remembering that your stock most likely isn't doing anything unique to the rest of the market. So your company's full fair market value is down, or the 409A is down, and that sucks. I know it sucks to log into Carta or to log into your stock account and see that that value has dropped. It's not maybe what it was before. We remember the golden days of when it was worth $20, $30, $90. And maybe now it's, we're looking at much lower numbers. Believe it or not, a company's stock price has a whole lot more to do with the market conditions that are outside of that specific company than with the company itself. So, it's not a guarantee that your company is going to ace this thing, but a declining stock price doesn't necessarily mean that your company sucks or that your company's equity is completely useless. It's much more based on what the market as a whole is doing. Another big point is considering the impact to your company's liquidity time horizon. We've got a lot of clients who have equity compensation in private companies who are waiting on that liquidity event. And it may mean that we need to wait a little longer. It doesn't necessarily mean, like I said, that, it's that this market condition is the kiss of death for your company, but it may mean that IPO is delayed by 2 or 3 years, or maybe even longer. Big thing to remember here is sticking to your trading plan. So the first thing that you want to do in a bear market is make sure that your portfolio is as properly diversified as possible between a variety of different asset classes. We don't know which asset class is going to rebound first when the bear market begins to correct. So diversification kind of tamps down on a lot of the volatility that tends to increase during bear markets and puts us in the best position to capitalize when things kind of correct themselves. So sticking to your trading plan, I know it's very difficult when your company's stock price is down. If you are dealing with a public company and you are kind of divesting out of company stock, we'll talk about that in a minute, but definitely stick to the trading plan. Staying invested and maintaining a long-term focus, it really goes without saying. I mean, that is advice that we can give you in pretty much any market. Most of our clients are fairly young. Most of our clients have a reasonably long time horizon for financial independence, for retirement, if that's a goal for you. So maintaining that long-term focus and knowing that, even though bear markets aren't exactly short, I think on average, they lasted about 289 days. 289 days is not going to make and break your financial plan. We are planning for much longer than that. So just kind of keep that perspective. And then the biggest thing, and my favorite thing to mention, is if we've got lemons, let's make lemonade. We are actually being presented, I know bear markets are tough for clients to kind of muscle through. It's tough for all of us, but we are being presented with some opportunities in this market. We want you to buy what's on sale. Every bear market in the past was ultimately followed by higher share prices. And the benefit of hindsight is that you can, you look back and you're like, oh man, I should have bought Google when it was that, $200 a share. So dollar cost averaging into the market can kind of help you capitalize on opportunities that are available that you may not even know are available right now. So kind of goes back to sticking with the trading plan, making sure that we're reinvesting into a diversified portfolio. We can take a look at the next slide, if you would, please, AJ. Thank you. So strategic planning for equity compensation during a bear market. How do we, do the best that we can to make lemonade out of lemons? Number one is if you have RSUs, sell them on vest and reinvest the proceeds into a diversified portfolio. So remember when we were talking about buying what's on sale and how it can be difficult to log into your stock account and see that the value of your company stock is down. And maybe mentally you're going back to the good old days when it was way up high at a much more favorable number. It can be really difficult for clients to want to let go of that company stock because we remember when it was at, $100 a share. Something to keep in mind, back kind of from our first slide, is that your company stock is probably not doing something that's unique to the rest of the market. So even though your company's stock price is down somewhat, so is the rest of the market that you're reinvesting into. So when we think about it, we're selling your company, maybe we're selling your company stock a little low, maybe it feels low, but we're also reinvesting low into a diversified portfolio that puts us in the best position to capitalize when things turn around. So it's not like you're selling your company stock low and then you're reinvesting into the stock market when prices are high. It's sort of much more of a lateral move there. Another big thing is selling. Think about selling any long-term company stock that you may be holding on to generate some capital losses. So tax loss harvesting is a huge part of our investment management here at Brooklyn FI. We're always looking for opportunities, when we do have down markets, to take losses off the table. And that is because a lot of our clients have significant capital gains from year to year that we're looking to manage on the tax planning side. So if you have long-term company stock, maybe you joined a company, when prices were really, really low and you got a lot of, maybe you have founder stock, or maybe you have, just very early on stock that has a very low cost basis. In a normal, thriving, healthy, happy market, probably the gains on that stock are pretty gnarly. And, maybe we need to be a little bit more judicious about how we divest from that. But in a market where prices are down, that gain has shrunk, and maybe we even have a loss. If we sell that position, we can take that off the table, we can reinvest it. If we generate losses, we can net them out, net them against capital gains for the current year. We can actually count up to $3,000 in capital loss against your income for the year. And then we have unlimited carry forward. So if we generate $100,000 worth of losses, we can carry whatever we don't use in the current year forward. So it really does put you in a good position and kind of gives you a capital gain budget potentially for future years. And then another point is, think about making use of your employer's ESPP if they offer one. This can be a good time to do that, to leverage those sorts of plans. So for each calendar year in which the offering period is effective for your ESPP, you have a $25,000 limit. So you can put $25,000 of your salary towards buying company stock. A lot of times ESPP will offer you a discount of up to 15% on the fair market value. So even in a down market, if you're getting that discount of 15% and you can turn around and sell the stock, you've just made 15% of whatever the fair market value is for your company. So you can still make money in that way. Something to look out for, though, is if your company has any holding restrictions. We have seen ESPP plans that have those holding restrictions, lockup restrictions, where you cannot sell the stock immediately on purchase. So just kind of keep an eye out for that, but that is something you can take advantage of. Oh, thank you, AJ. Yes, employee stock purchase plan.
I was like, I think everyone is on the same page, but I'm just going to write it out just in case.
Good call. Awesome. Cool. So big question for a lot of our clients. We have a lot of folks who are kind of in this position right now. What do I do with underwater stock options? So if you've got underwater stock options, the answer is pretty simple. If you ask John Owens, our director of financial planning here at Brooklyn FI, he will tell you nothing. One word. You want to take a look at your grant documents, see when your options expire. So typically you're going to have about 10 years from your grant date to exercise those options. If you do leave your job, that is expedited to 90 days, give or take. Always check the grant documents. Don't take the general numbers for godsend or for gospel. If you have time, once we know the expiration date, if you've got time, just sit tight. Don't do anything with them. As we have mentioned several times now in the presentation, markets are cyclical. So if you've got time, sit tight. Part of the value of having options is having that time to sit and wait. Follow-up question, what if I already exercised my underwater stock options? Let's consider selling to take advantage of tax loss harvesting. Again, same kind of theory as before. We can use that to offset capital gains in the current year. We can use up to $3,000 against your income for the year, and then whatever we don't use, we can carry it forward, and we can think of it as like a capital gains budget.
Yeah, I think one thing we forgot to say kind of in the beginning is, here a lot of the advice we give to clients, we're kind of speaking in platitudes and like generalizations. Like none of this is advice for you. It's really just like how to think about equity, because if we're doing this presentation this time last year, our tone would be different. The advice doesn't change that much But the tone changes, right? We got to hunker down. We got to make it through. Let's capture some losses. Whereas last year we were talking about, oh my God, we've got huge gains because it was a banner year for IPOs, and we got to figure out, let's stack our charitable contributions because we got to figure out a way to minimize that gain because we don't have any losses, because our concentrated position is up 100% year to date, and our diversified portfolio over here is up 30% year to date. There's just markets change, so the advice changes, and it has to be tailored to you. So I know I see a lot of clients on here, so you probably have a plan in place with your planner. If you feel like you don't, if you feel like your plan is a little stale or you need some advice on something, reach out to us. That's what we're here for. We do these webinars to kind of communicate like how we're thinking. But if you need something, if you need your plan adjusted or just want to talk through it, we are always here for you.
Totally. Yeah, it's kind of like, I like to say the notes are the same, but the song is different.
I like that. I like that. So how to evaluate compensation and benefits? So we're talking a lot about equity compensation. That's probably why you're here. You want to talk about stock options and RSUs. But I also like to think of those, in the context of job offers, because it's not just compensation that employers offer, right? Employers, they want you to do the work. They're going to pay you for that work. But they also want to incentivize you to stay there. So this is a really personal question. This is related to financial planning, but for each person, you kind of need to answer this question for yourself. Like, what is most important to you? A lot of people are going to say salary, right? A lot of people can find lots of things to do with money. We can have a nicer home, nicer cars, go on more vacations, pay for college education, all that good stuff. Bonuses, that's part of salary and compensation. Equity, that's what we're talking about here today. But then there's all these like other kind of like other things that get added on. And it's kind of hard to value them. Some of them have true dollar values. For example, a 401k match. We can calculate, if you're going to get a 4% salary match, how much free money or how much of a bonus that's not taxed each year you're going to get. That's fairly valuable. As a financial planner, when we see 401k match, we don't want to walk away from that. So when you're evaluating new job offers or looking at new, a revised benefits package from your company, this is really an opportunity to look at your total compensation package. Because especially if you're looking at two new offers, one salary over here might be a little bit lower, but this company's got a 6% 401k match. Oh, and by the way, they'll pay up to $30,000 for you to freeze your eggs, and if that's something that's part of your life plan and your financial plan, well, that's a pretty valuable benefit to you. If that's not a part of your life and that's a benefit you're not going to use, then that's probably not a lot of value to you. So we just don't want you to forget about all these other benefits that have varying levels of importance and varying levels of value to the individual. One that I just have to highlight because it's so important and can be so expensive is disability insurance. We could spend a whole other webinar talking about it, would put y'all to sleep. But basically, we're talking about long-term disability insurance. All employers have to offer short-term. You fall and you break your leg, those are state rules. We're talking about long-term. We're talking about you lose the ability to do your job and your income is protected. So we see a lot of tech companies offer incredibly valuable disability insurance plans. So don't sleep on this benefit. If you're self-employed, typically you need your own disability insurance, and it can be very expensive to the tune of $5,000 to $10,000 a year. But it insures your income. So we're talking about potentially millions and millions of dollars in payouts from that insurance. So that's my little disability insurance soapbox for the day. So yeah, decide which of these is important to you, and that can also help you in negotiation. Obviously, salary and equity, those are going to be our big ticket items, but don't sleep on these other ones. So yeah, what is the true value of these things? So let's look at a paycheck. Here we've got health insurance that an employer is going to pay. For those of you who have gone out to get your health insurance on the market, you've probably found prices. If you've got a family, probably around $1,000 a month. Pretty valuable benefit for an employer to cover. Like we talked about 401k match, that's money to you. We call it free money. I don't know why financial planners call it free money. I have no idea. It's tax protected money that it's great. Anyways, commuter benefits. Personally, go, who cares on this, especially as a New Yorker. Like it's a small tax savings on a Metro card. That to me has started to matter less, especially now that we're all working from home for the most part. And then just the ability to contribute to a 401k is very valuable. So we don't want you to underestimate, even to the fact that the company just offers the 401k is huge. Even if there isn't a match is really great and nice. Brooklyn FI does offer a match to its employees. And we didn't do that in the beginning, right? It took us some time to get up to a point where that was a proud moment for me as a business owner to be able to offer that. But just having the 401k available for you to contribute, I believe is a big benefit.
Totally. If you don't have that 401k benefit, I was just talking about this with somebody the other day. If you don't have that 401k benefit and you're saving to a traditional IRA, you're limited to only saving $6,000 a year, $7,000 once you're over age 50. With the 401k, you can save up to $20,500 prior to age 50, and that's every year. And then after 50, you can save $27,000. So you can see, you don't have to be a financial planner to do the math on how much further ahead for retirement having a 401k, even without the match, puts you.
Yep, we love 401ks all day long. And yeah, here I just go through kind of like each individual benefit. I'm not going to read these off. If you're watching, you can pause, you can come back and read this later. Parental leave, again, I've seen some companies where they do, if you're working in Scandinavia, or is it Germany, where you get like 3 years off or something awesome.
Yeah.
In the States, you just get a couple weeks. But I have seen companies offer a year off. If adding to your family is in the plan, that benefit is so valuable to you. In my mind, that trumps salary, that trumps all the other stuff. So again, it's really a personal decision, being able to evaluate these benefits. Medical plans, expense, a lot of employers cover them. Vision, dental, not big ticket items, we can skip those. Life insurance, kind of if they have it, that's nice, but typically those are offered either through the employer or you can go get your own policy. Quick little note on that though, if you do have some kind of underlying condition and it might be hard for you to get insurance elsewhere, sometimes joining if you work for a big employer, joining their insurance plan, there's more people on the plan. Sometimes it's easier for you to get insurance if someone else has denied you elsewhere. And we already talked about disability, why we love it so much. So with all of those things in mind, so negotiating for more compensation in an existing role, we're switching back to the actual compensation piece of this and thinking about it in terms of equity. So you're at a company now, you like your job, maybe there have been layoffs, maybe the mood is a little dour because the stock price is not what it was around this time last year. So maybe it's an opportunity for you to do some negotiating. Maybe with the downsizing, there have been some open positions. So we're going to kind of talk through what are the things that we're thinking about right now. Number one, asking for repriced options. This is pretty hard to do because repricing options requires the company to go back to their shareholders and say, hey, remember all those options we granted during our last board meeting? Well, the price was wrong. And if we don't reprice them, all of our employees are going to leave because they have worthless or underwater stock options, which Kate was explaining earlier. So Peloton, this is an article from a couple of weeks ago. Peloton actually did go and reprice their options because they exercised, all the grants back in March had a price of $27.62. Now the stock is trading around $10. So those are worthless options. So they actually went back and re-granted all those stock options, which is cool. Again, hard to do, hard to pull off, but it can be done. So that's something that, you kind of, as an employee, you want to get a bunch of people behind you, talk to the CFO if you can get in their ear to start that conversation. Asking for RSUs, like we said, typically when we look at the hierarchy of all the different ABCs, the ISOs, the non-quals, and the RSUs, each person is different. It depends what you're looking for, what the rest of your financial plan looks like. ISOs are kind of the riskiest with the biggest tax surprises. RSUs are kind of the most straightforward. In this market, if cash is an issue for you and you are relying on that equity compensation to fund your lifestyle, RSUs are probably the way to go because those options are just going to take a long time well, we don't know how long it's going to take. It could be a long time. It could be a short time to get that cash, into your bank account. So RSUs are kind of our straightforward, when we're negotiating, let's just get more compensation in our pockets now. And if cash is, if cash is king and you're sick of the volatility of the stock price and you find out that you don't have this appetite for risk and, your heart is palpitating every time you log into your E-Trade account, ask for more cash. This is, it's, as a financial planner, it's hard to even mention that just because there's so much value in options and we love investing. But at the end of the day, if a third of your compensation was based on a stock price and you can't pay your rent, it might be time to think about converting back to cash. And of course, asking for more stock, it can't hurt in your negotiations. If you do want to wait it out, you like the company, you understand the cyclical nature of markets, ask for more. They'll probably be happy to give it to you in this moment. Whereas if we wait a year when the price recovers, or if the price recovers, might be a little bit harder to get more stock at that point. This last one, use this opportunity to ask for a promotion. Unfortunately, maybe there's been some downsizing, maybe someone's left. Maybe you don't want to be at this company forever, but getting promoted to that next level probably puts you in a different salary group or salary bracket to go then leap to the next place. Our clients do leap around a lot. A little bit of unsolicited advice here is, if you like the place and the stock isn't doing well, don't jump ship right away just because the stock price isn't what you want it. Typically, employers, things can get better, things may recover. I think they will. I say may because I don't like to make predictions. But yeah, that's where we're at.
Difficult to get financial planners to talk in absolutes, isn't it?
Was that? Yeah, exactly. Yeah. The answer to all of your questions, by the way, is it depends. Yes. So markets may recover is my answer to that. So yeah, that's how to negotiate. In your existing role, there's a bunch more. So happy to answer any questions around that. What about a new role? What about when you're evaluating offers from different places?
Yeah. So let's say, you attempted to negotiate for more in your current role and it didn't work out. And so, things go south and you decide to pack a bag and hit the interview circuits. Couple things to keep in mind. Start with figuring out what's more important for you, kind of like what AJ was talking about. Is equity more important, or do we need that cash compensation? Do we need that salary in order to survive, to make the plan work? And the best place kind of to have this conversation, in my opinion, is in a planning meeting, right? So contact your planner at Brooklyn FI. Let's hop into Right Capital, or even hop into Right Capital on your own. You've got 24/7 access. Take a look at the plan, and let's make sure that that you can achieve your goals with your current level of income. And then if there's room for us to take risk, as AJ said, it's a great time to maybe even get more options, get more stock, and then just wait it out. Because I'm a big believer that, part of the value of options is the time value. So just something to kind of think about there. Kind of do a little bit of market research, go into it, educated. What are other people making for the role that you're interviewing for, or the role that you're targeting? Ask around in your network to see what other people with that title are getting paid in similar companies. And, just kind of get a feel for what's a fair ask. You also want to get a firm grasp on the value of your current compensation before you go looking elsewhere. So kind of going back to, that's why we did that whole segment on how to value your current compensation. Look at everything, right? Look at your 401k match, look at the disability insurance that you're getting, look at the premiums on the life insurance, the health insurance coverage. Do you have access to an HSA? Does your 401k, your current employer, have after tax? If it has the after-tax option, then you're saving far and above what you can put into a regular 401k. And that's a huge benefit that is not found at all employers. So, kind of taking stock of all of that and doing an inventory of what you currently have. Looking at the time value of your options, looking at vesting schedules. This is a huge thing. If you have RSUs through your current company, look through your vesting schedules and add up how much stock you have vesting. And then just kind of, get a feel for what that's worth. And don't forget about your cash bonuses. If you're making an annual bonus, look back, if you've been there 5 years, look at what you've made in bonuses in those 5 years and find an average number. and kind of incorporate that into your current compensation value. I think there's more on the next slide. Yeah, so like AJ said at the beginning of the presentation, if you're not into taking on significant risk, we want to be with RSUs. You can kind of think of RSUs, AJ is going to cringe when I say this because it's a lot different from a tax perspective, but like you can think of RSUs as a real complicated form of a bonus. It is stock that's coming through to you and not cash, but and there are some tax hangups there, but you can think of it as a bonus that you have to jump through some hoops to get to, right? So we can sell these guys when they vest, reinvest it into a diversified portfolio after you have paid the supplementary tax that Brooklyn FI is going to tell you to pay. Please do that. And it's over and done with. Very simple and easy for you as the client. If you're a little more adventurous, think about ISOs. There's more risk that's associated with incentive stock options, but there is exponentially higher potential reward if you do end up finding a unicorn. So we have seen it at Brooklyn FI time and time again, clients who, did find the unicorn and they had incentive stock options, they were able to have a higher degree of control of when that compensation would be taxed to them and how it would be taxed. So something to consider there. So once we've kind of gone through, we've assessed ourselves for risk, how much risk we want to take, how much cash compensation baseline that we need to, keep things together and be comfortable and not be worried. That's a big piece of this, right? The numbers could add up for you to take a salary of $200,000, but maybe you're not comfortable with that. Maybe that doesn't allow you to have enough liquidity to sleep at night. Please do not take an offer that is less than that if you are not going to be able to sleep at night, because in a bear market, like I said, things can get gnarly and we want you to be able to sleep. We don't want you to be, totally freaked out because we may have to ride this out for a while. So be honest with yourself when you think about risk tolerance. But once you've arrived at a number that you feel comfortable with, ask for something higher than that number and don't justify it. Just do it and see what happens. Leave yourself room to negotiate, because odds are, if you come out with an ask, most likely the company is going to come back at you with something that's less than that. So leave yourself space to negotiate it out and, see what happens.
Yeah, it doesn't hurt to ask, right? And I think part of this is also to put a little bit of a dour wet blanket on everything. Some clients are and in my friend groups, you might feel like you don't have a choice, right? Maybe you got laid off a few months ago and you're interviewing and this role looks really great and you just take the job. There's nothing wrong with that, right? So, but taking the job doesn't mean there is not room for negotiation, right? Just because it might feel dire, maybe you ran through your emergency fund, like, I got to make a move, I got to start having some income, I've got a family to feed, like, great, like, this is the opportunity, it seems fine, let's take the job. But don't get caught up in that, like, oh my gosh, thank God I have income again. Like, there's always opportunity to fine tune that offer, look at that list of benefits, figure out what's available and where there is room to negotiate. And that's kind of like the beauty of equity compensation, is that it is so unique, it is so individual. We have investors who already have billion-dollar portfolios willing to take a lot of risk, willing to take on a lot of early risk with companies, because it's not going to impact their net worth dramatically. If they put $500,000 into something and they lose it all, their kids still get to go to college, things like that. So it's all relative, or as we like to say in financial planning, it depends.